Good morning. It's Tuesday, the 18th of June, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital. So now the markets are holding now at their record highs, but have also entered a period of limited good news exposure as I see it. Now, what are the triggers that could either drive up or upset the market? Because you have to think of both sides, or for that matter, the economy. Well, the first trigger is already here, a loud warning bell that the monsoons for all the projections of surplus rainfall have begun on a low note. More on that shortly. Taxes are the other. Now, there are increasing reports and rumors that taxes could be reduced, but I suspect that there could also be increases coming. An increase in taxes could hurt market sentiment, while reductions will obviously improve them. Speaking of taxes, it's near criminal to treat air conditioners as luxury items and charge them a goods and services or GST rate of 28%. Air conditioners are now no longer a luxury but a necessity at a time of increasing heat waves. Now, not everyone can afford them, obviously, but we have to bring down taxes to make it more accessible for more citizens, including and most importantly for those working in trying conditions like the millions of small and medium enterprises that form the backbone of the economy. Power rates need to be brought down too. That's a separate discussion. I really don't know of how many countries where commercial electricity rates are higher than residential and thus disincentivized. On to today and our top stories and themes. The markets are at record highs, but the foundation is likely to stay weak. India may lower personal tax rates in categories to boost consumption. Monsoons are now showing a 20% deficiency, a worrying sign. Hyundai's parent stock hits a record high on news of listing of its Indian arm. And the logjam at ports is set to worsen, driving up container rates and more delays.
This is a call report with Govindraj Ethiraj.
Markets are at record closing highs, but like we discussed earlier, the markets, for all the strength that they have been displaying of late, are on a somewhat fragile footing right now. And the big positive moves, if any, will come with the union budget next month, which in turn is likely to be more tax-linked than anything else, for the very simple reason that there are very few rabbits left in the hat to pull out. Anyway, to recap last week, once again, the indices ended at a fresh closing high on Friday, and stocks like HDFC and Reliance Industries were strong. The NSE Nifty 50 closed 66 points higher at 23,465, and the BSE Sensex was up 182 points at 76,992. The markets, just to remind you, were closed on Monday, June the 17th for the festival of Eid, and will resume today after obviously a long weekend. Meanwhile, oil prices are rising, as we discussed yesterday as well, and now it's showing its biggest weekly advance since early April, according to Bloomberg. Brent is now trading above $83 a barrel after climbing nearly 4% last week, the first weekly gain in 4 weeks. Crude futures were also ruling higher last week, reversing a sharp drop after OPEC, that's the Organization of Petroleum Exporting Countries Plus, signaled the return of some output to the market later this year. Oil has trended lower since early April on signs of strong supply and concerns over demand, particularly from China, all of which continue. OPEC Plus, by the way, shook up the market recently when it said that it might return more output later this year, forcing key members to clarify that the group could pause or reverse production changes if necessary, according to Bloomberg. Now, this obviously makes the entire proposition redundant, and we don't know either way. So let's see how much oil really flows this year. China's oil refining or throughput is expected to be flat or fall this year for the first time in 2 decades, apart from a COVID-19 slump, according to market watchers surveyed by Bloomberg. Will the government lower taxes? Now, there is a consumption slowdown for sure, and that also shows up in the form of a pretty sharp gap between the overall gross domestic product or GDP numbers and private consumption number growth. Just to back up a little, consumption is not driving growth in India at this point. In 23-24, private final consumption expenditure grew at only around 4% against the 8.2% GDP growth. Now, that 8.2 figure is obviously something that you've heard and have been hearing. Now, the 4% is obviously not something that you would have heard much about. Now, this is obviously a little unusual, to put it mildly. However, gross fixed capital formation or investment grew by almost 9%, which of course is reflective of the large public investment push in infrastructure and beyond. So read the news that follows in this context. Reuters is reporting that the government is considering lowering personal tax rates for certain categories of individuals, which could help boost consumption. The plan could be announced in next month's union budget. A cut in personal tax could boost consumption and increase savings for the middle class, according to sources who told Reuters. Now, the category of individuals that may see some tax relief are those earning over 15 lakh rupees a year or about $18,000 annually. So in 2020, the tax slab had been changed in a way that annual income up to about 15 lakh rupees was taxed between 5 and 20%, while earnings over 15 lakh rupees, which is $18,000, is taxed at 30%. So you can see the jump. The idea is to see apparently that if there are some new slabs that are possible, since the jump between the under 15 lakh and the over 15 lakh is quite substantial and almost 6 times in some cases. Meanwhile, Business Line is reporting that over the last 2 to 3 months, monthly household shopping bills have risen with price hikes in the range of 2 to 17% on some brands and categories of foods and personal care products. Prices have been raised between 2 and 9% on soaps and body washes, 8 to 11% on hair oils, and 3 to 17% on some food items, according to trade data and analysis, says Business Line. This hike in prices comes after close to a year of declining price trends with moderating commodity prices. And by the way, management commentaries from most companies during their earnings calls have pointed to pricing growth in this year with an inflationary trend seen in some commodities, according to ICICI Securities in a note last week. The monsoons are 20% deficient. India's monsoons has delivered a fifth less rain than normal so far this year, Reuters quoted the Indian Meteorological Department saying. Now, this is obviously a worrying sign for the economy in general and the agriculture sector in specific. Now, it will take a day or two to work out the impact of this at this time. It is, of course, not necessary that the impact will be high because rains will most likely make up in coming weeks. But summer rains, as they're called, which start around June 1st and spread across the country by July 8th, are important and help farmers in planting rice, cotton, soya beans, and sugarcane, according to report by Reuters. Now, India has received about 20% less rainfall, that's the fifth that I spoke of, than normal since June 1st, according to the IMD's data, with almost all regions except for a few southern states seeing shortfalls and some northwestern states experiencing heat waves. The rain shortfall in soybean, cotton, sugarcane, and pulses growing central India has risen to almost 30%, while the paddy growing southern region received 17% more rainfall than normal because of the early onset of the monsoon, according to the data. Now, it will take a few days for all of this to be computed, but we also have to wait for a few more days to see what the real impact will be. An IMD official told Reuters that the monsoon's progress is stalled, it has weakened, but when it revives and becomes active, it can erase the rain deficit in a short burst. Hyundai parent stock hits record high. More news as expectations and interest rise on Hyundai's initial public offer in India, possibly the first and surely major one from a multinational listing in the country, that's India, after many years. Meanwhile, the news of that being India's largest initial public offering as well has already boosted Hyundai Motors stock to a record high, according to Bloomberg. The Korean company is selling a roughly 17% stake in Hyundai Motor, according to its draft red herring prospectus filed with the Securities and Exchange Board of India. Shares of Hyundai, which will take in all the proceeds from this IPO, rose about 4% on Monday in Seoul. Hyundai wants to raise about $2.5 billion in the IPO with a potential listing by the end of the year, according to Bloomberg. And this would rival, says Bloomberg, the 2022 listing of Life Insurance Corporation of India for the largest IPO on record. Now let's get a view from the other side. An analyst at Kiwoom Securities says that the IPO sends a clear message that Hyundai Motors' India investment will increase. While investors had invested higher investments in North America and Europe, they had not expected a big output increase in India. Incidentally, the stock prices of Hyundai suppliers and subsidiaries climbed on expectations that they will benefit from expansion by Hyundai in India. Container shipping rates are rising dangerously. Inflation looks to be easing across the developed world except for the cost of moving cargo by sea. Spot rates for full-size shipping containers to the United States and Europe from Asia rose again, according to latest data, with three key routes, all topping $6,000 for a 40-foot equivalent unit, according to the analytics firm Drewry World Container Index released on Thursday. Now, these prices have tripled since the end of 2023, though the pace of increases is moderating, said a report in the Economic Times. Singapore's maritime gateway, amongst the world's most vital for seaborne freight, is facing now a sustained period of congestion, as we discussed yesterday as well. The waiting times for berth space there is nearing 5 days, according to industry estimates, and it's ranging from 1 to 4 days in the Chinese ports of Ningbo, Shanghai, and Qingdao. According to Drewry, the cost of a 50-foot container to move merchandise to Los Angeles from Shanghai last week rose about 0.8% to around $6,000.25. This was the sixth straight week of gains. Drewry also said it expects that freight rates from China will continue to rise next week due to congestion issues at Asian ports. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.